Hey Doc, how are you? Thanks everyone for joining for another episode of Wilson Weekly. We've got Doc Wilson as always, the star of the show. What's happening, mate?
Yeah, g'day, Chris, and we've got some interesting information as usual this week. We're well into April. Of course, we're all looking forward to the Easter break, and that starts in a week's time. Nearly a
It
week's
is.
time. Well, just over a week. So we have the Easter break, and then we have a couple of days back at work, maybe, and then we have we have Anzac Day, of course, on Friday the 25th. So it is the holiday month, April. We're all a little bit distracted, but nonetheless, the housing market keeps on keeping on, and that's what we do here every week. We keep you up to date with what's happening in real time, if we can, in terms of the housing market, not just the facts and figures, rents and prices, etc., but also those key drivers, particularly those that relate to interest rates. And gee whiz, Chris, there's been a lot of talk about interest rates this week. And what a big week it's been in globally for economics. Of course, we've had the announcement by the US administration that they're going to load most countries up with tariffs on their imports. The country's exports, which of course the US imports, are now going to cost more because of tariffs. Well, they're going to cost more to someone, whether it's the importer or the exporter or the consumer. We'll find out perhaps, but there looks like being no backing down from the US government in terms of its new tariff policy. Interesting to see where it all lands. I'm not so sure it's just leverage at the moment. I think they're quite serious about changing the trade rules, the environment for trade, global trade, as a big picture scenario. And gee whiz, why wouldn't you want to change it when you're the world's biggest customer, which the US is, 320 million consumers, 330 million consumers. So everybody wants to sell product to the US because there's lots of buyers there. And when there's an imbalance in trade, it makes you start to think, well, is this fair? And I think that's part of the reason the US has moved particularly strongly against those that it has a trade deficit with, and that's the Eurozone, China and Canada. So where are the cards going to fall? There's lots of scary doom and gloom stuff around. Of course, we always see that in times of severe uncertainty. The last time, of course, was when we had the COVID epidemic, and there was lots of scary headlines there, and perhaps justified because we didn't know where we were going. Similar here, but gee whiz, really, I think we're a week into this. Nothing's really happened, and yet we've got, the word recession, depression, whatever you want to say, floating around, predictions of massive cuts in interest rates. Where are you? And of course, the banks are at the forefront of all these shock horror type of headlines and predictions. I think the banks are predicting a full 1% cut in interest rates this year. It's a bit of deja vu because weren't they predicting that last year? But they don't have a great record. But, they have vested interest, of course, in interest rate policy. And the government's right on that bandwagon. We're in the middle of an election campaign. Maybe the thoughts are if you scare the voters enough, they'll think, well, we don't want to change government. I think the polls tell us it's a pretty even contest at the moment. So maybe that's their latest strategy to try to retain government, is to scare people into not changing the driver in the middle of the race. But we'll see how it all pans out. But certainly the real data is still quite strong, particularly in the housing market, and we'll look at that shortly. In fact, we're going to have, talking about interest rates, some real incisive interest rate analysis today, because we've got the latest inflation data to look at. And if anything, that's looking a little positive for an interest rate cut going forward. Not four, but maybe one. But we're also going to look at the latest data for the rental market, which is very interesting as well. And finish off as usual with the latest auction results from last weekend. It's interesting, this coming weekend will be Super Saturday. Last week, the auction results over the full week, not just the weekend. But this coming week, particularly Saturday, which is the pre-Easter Super Saturday of auctions, we typically get a surge in auction activity on the Saturday before the Easter break. That's, of course, because sellers and agents want to avoid, the distractions of a longer-term holiday period. So it can be one of the biggest auction days of the year, that Saturday before Easter. So it will be a real test for the market. Lots of auctions occurring. So the law of supply and demand, will that put downward pressure on clearance rates? So big test for the market. So I've done enough of a preamble. Let's not talk too much about what's going to happen in the show today. Let's be more about actually telling the show what is going to happen. So My Housing Market is my brand. We act as independent commentators and data providers of the housing market. We're all about the current state and future prospects of your housing market, and emphasis on current state. We, in conjunction with the good folks at Infinity, which brings you this podcast every week, are all about making informed decisions about the housing market, whether you're a buyer, a seller, an investor, a tenant, or just generally interested in what's happening in the housing market. We try to provide you with accurate, incisive, evidence-based information. No clickbait here. This is a clickbait-free zone. As I said, our responsibility is to our viewers to enable them to make informed, rational decisions about the housing market. We do that every week. So let's get started. This is the week ending April the 9th, second week into the month of April. So we're beyond a third of the year now. We're beyond a quarter of the year now into the thirds. And we certainly have a real sense of what's occurring in our housing market. So although we will get some distractions over the next few weeks, we'll still be able to produce some data that'll give you those insights. So this week we're going to look at March home rents, hot off the press, the latest rental data, the February inflation data, which is very important in terms of the outlook for interest rates, and as usual, the latest weekly auction results. So let's have a look at the latest home rental market data. This is for capital cities, and it's tightening again. We saw it tightening over February, and that has continued into March. A couple of factors working here. Firstly, of course, when we go through that December, January, February period, it is a period of less demand for rental properties because, of course, we have people on holidays, and the school year is finished, the higher ed year is finished. But when we move back into February and March, we tend to get more demand because the school year starts, we're back to work, and people get focused on those accommodation decisions. So we generally see, because of seasonal factors, a tightening in rental markets. Same thing happens with prices for units and houses as well. We get that seasonal effect early in the year. But now we're seeing some real tightening occur for the second month in a row. We saw typically the tightening in February following the January's easing results, but now we're seeing that consolidating now into March. So this isn't good news for tenants out there. Really it's a trend that's continuing. And I guess the sobering nature of this, particularly for the tenants' point of view, is we look like we were having some relief last year from what's been an extraordinarily tight rental market over the past few years, with skyrocketing rents and record low vacancy rates. It looked like we'd sort of moved through the cycle in terms of that very tight rental market in the second half of last year. But now we're back to those very low vacancy rate numbers. So it's really a case of we're just not building enough houses over the longer term or units to satisfy our accommodation needs. And even though we can get some ups and downs in terms of changes, particularly in the rental market, the longer term view or longer term data is still showing it's a very tough gig to find a rental property in most capital city markets. So let's have a look at the overview. Is that rental markets continue to tighten through March, low and falling vacancy rates generally, and we're starting to see those early signs of resumption in rental growth. It takes some time when we move back into a tight vacancy rate, a tight rental market environment for the rents to follow. But they will follow because once incomes start to grow and affordability constraints ease, we will see higher rents because, you have to pay more if you want to secure a rental property, particularly when there's such a shortage as we're seeing now. We are seeing those early signs of higher rents, but that'll take a couple of months to consolidate that higher rent environment. So keep an eye on the rental data as it comes through. So this is these results. Sydney's still the highest rent in the country for houses, 798 median asking rent over March. That was down slightly from the $700, so down by 0.3%. Melbourne was steady, Brisbane was steady, Perth was steady, Canberra was steady. So it starts off when they're steady and then they start to rise. But Adelaide was higher by 1.2%, and Hobart was up 3.5%, and Darwin was the underperformer, down by 1.4%. So house rents have been reasonably solid. The growth in house rents over the past year, reasonably robust. Hobart top performer with Darwin up by 6.1%. Hobart, Darwin up 9.3%. They're volatile markets because of smaller numbers of properties in the market, the rental market in those smaller capitals, but nonetheless, that's significant growth over the year. Perth up 5.3%, Adelaide up 5%, Brisbane up 3.2%, and Sydney up 2.2%. So moderate increases over the past year. Melbourne house rents have better news for tenants, are still lower than where they were a year ago. But the real news out of the March report, Chris, is these vacancy rates. And generally, most of the capital cities reported either lower vacancy rates over the month or steady vacancy rates over the month. The exception was Adelaide, where vacancy rates were higher. But let's have a look at those vacancy rates per se. Look how low they are again. There's only one capital city with a vacancy rate under 2%, and that's Canberra. And we always point out that 2% is usually the balance, point between higher and lower rents. Anything under 2 usually means higher rents, over 2 lower rents. But look how low they are. It's only, with the exception of Canberra, only Melbourne and Sydney have vacancy rates above 1%, and they're just above 1%. These are very low numbers, Chris, and really do signal, as I said, a shortage of rental property, which promotes lots of competition for available homes for rent, houses for rent here. And that, of course, means, upward pressure on rents and long queues of prospective tenants in properties that are available. And this is the second month in a row we've seen that. And as I said, the trend is still downwards, but these vacancy rates are very low again, and that would be some concern to tenants, but better news for landlords if they're looking for higher rent in the outlook. So that's houses. Units, similar story, maybe not quite as strong, but we had higher rents in Sydney for units, up by 1.4% over the month. Melbourne was steady. Brisbane down by 1.2%, which is breaking a recent trend of higher rents in Brisbane. Adelaide up 1.2%. Darwin again reviving, up by 5.7%. Darwin rents over the month. The annual results, still some big growth or significant growth in annual unit rents in Adelaide, up 10.5%, Perth up 8.8%, Darwin up 9.1%. Sydney unit rents are flat over the year. Melbourne are actually up 1.7%. We're actually seeing a bit of a revival in that Melbourne housing market, not so much in house rents, but certainly unit rents. And of course, as we reported recently, house and unit prices are also rising again in Melbourne. Now, obviously, we need to see if this is going to consolidate over coming months, but certainly a good start to the year for the Melbourne housing market, particularly for units. Vacancy rates a little bit higher for units than houses, but still quite low. Melbourne and Canberra at that balanced mark of 2%, but Melbourne's vacancy rate has come down quite sharply over the past 2 or 3 months, and that does reflect the end of that the seasonal effects of less demand through the December to January period. But yes, Melbourne's vacancy rate is now coming down quite sharply for units. But again, we're seeing low vacancy rates, just above 1% or below 1% in all our capital cities, with the exception, as I mentioned, of Melbourne and Canberra that are at 2%. So no real good news in comparison with the unit markets compared to the house markets, with vacancy rates still very, very low. And these are, vacancy rates on a consistent basis we've really never seen before, that we've experienced over the last couple of years, which just really does show that we've run out of houses really in this country. And next week we'll look at the latest building approval data, and I don't think there's much joy there to see a revival in building that could offset some of this undersupply. And again, we're seeing a downward trend in vacancy rates, or steady vacancy rates, over the month for units. So this is this emerging trend, Chris, which, as I said, is not good news for tenants and will likely result in higher rents sooner rather than later as it continues. But of course, we are moving into the holiday month of April, so there will be some seasonal effects perhaps as a result. But let's wait and see when we see those results. If you want to get a full copy of the monthly March rent report from My Housing Market, there is a QR code. As usual, we provide you with PDF copies of our full reports as an exclusive here through Infinity and My Housing Market. So if you want to get a hold of that, get your phone out, take a scan of that QR code, and that will give you a link to so you can download that latest PDF copy of our latest rent report. So let's talk interest rates, shall we, Chris? Everybody's talking interest rates at the moment. Doom and gloom, scary stuff, clickbait, you name it. But let's have a look at some of the hard data. This is the latest data we have, which is for February. This is the monthly data. So coming up soon, we'll get that March data. And of course, what we'll be waiting for will be the March quarter data, which comes out at the beginning of May. So that'll be what the Reserve Bank is really focusing on for its interest rate decisions, because it has said that it looks at the quarterly data set rather than the monthly data set. But the monthly data set gives us a good forward indicator of what that quarterly results would be. So it's instructive to look at that. So there was some good news on inflation over February. The headline inflation rate fell to 2.4%, down from 2.5%. But importantly, underlying inflation, which is the measure the Reserve Bank favours, also fell from 2.8% to 2.7% over the month. And that's right in the middle of the preferred target range of 2 to 3%. Now, the reason why we saw a fall in inflation, firstly, the headline rate, we saw that the electricity subsidy, which of course has been an important driver of lower inflation, the handout the government gave us last year, $300 per household, that has meant a significant fall in the housing costs as measured by the inflation rate. We actually saw at the fall, so we're talking negatives here, let's get this clear. So the fall over January was 13.2%, it's a big fall, and that actually, over January it was 11.5%, and that actually got better for consumers to a fall of 13.2%, so a couple of percent more discount on the cost of electricity over the year as a result of that handout from the government. I hope this is as clear as mud. Not as clear as mud, but that meant that was an improvement in the housing costs, because we paid less for electricity over the year compared to the previous month. Same story with fuel prices. The previous month was a 1.9% annual discount on fuel costs, and that moved to a 5.5% discount on fuel costs. So that was what created that lower, essentially the lower inflation rate over February. There was also an improvement in rents from a 5.58% rise over January to a 5.5% rise over February. So that's why inflation fell, okay? We had a better outcome in terms of the cost of electricity, a better outcome in terms of the cost of fuel, and a better outcome in terms of rental costs over the year, all right? And what we're going to look at is the background to some of those drivers, because we're spot on here, because we look at the background to these drivers to see what the prospects going forward are for inflation, so we can understand what the environment is for interest rates going forward. So as I mentioned, underlying inflation is still within the range of 2 to 3%. So having when we discussed interest rates last week, of course, if you remember, we said that the Reserve Bank still considers the current interest rate to be in a restrictive mode. So that means it thinks that interest rates, if they were sort of normal, would be lower than where they are now. So there's some good signs there for lower rates with that current inflation data. So that's the chart there. We can see that inflation has certainly reduced from its peak back in 2022, 7.2%. A year ago, it was 3.9% annual underlying inflation. It's now at 2.7%. So the Reserve Bank has said it needs to have a consistency in terms of these results. So we're starting to see some consistency so that they can believe that it's sustainable, because we don't want up and down interest rates, do we? But of course, there's a lot of uncertainty now with this new environment in regard to tariffs. So underlying inflation is it at 3.3% in the US. So inflation is higher in the US, underlying inflation, than here at 2.7%. But our interest rate is actually lower than the US interest rate. So, an interest rate cut without an interest rate cut in the US would mean, obviously, that there'll be issues in terms of what that would do to the currency, etc. So better news on inflation. Let's look at the outlook. Inflation, as we saw there, is very sensitive to oil prices. Let's have a look at what's happened with oil prices. You can see there that oil prices have been reducing. It's not a completely one-on-one relationship in real time, oil prices and the inflation rate. But you can see there that we can forward project what oil prices are. And the average oil price over March was at $67.9 US and falling. So that's a good forward sign for what the March results would be, because we know the price of oil has fallen over March compared to February. So maybe we can factor in a better result over March in terms of that relationship with the oil price. So good news there, Chris. Looking forward again for what's happening with interest rates. And you can see there that the price of oil over the year to March actually fell by 15.5%, which is a significant fall. And that will have an impact, because we know what it is, the March price, obviously, because we're in April. And we can see that's a very clear relationship between the price of oil and the inflation rate. So good news going forward there for the prospects of lower interest rates, with a lower impact from the price of oil in prospect. Not in prospect, but in reality, because the price over the year to March was down by 15.5%, and that will affect the inflation rate. And we can see the tracking here of oil. It's actually fallen quite sharply on the latest results due to the scare campaign that's happening in the media in regard to tariffs. There was a big sell-off in oil. It fell down to just over $60 US. At one stage, it was under $60 US. It had been showing some increases before that. However, we've got to take this as a knee-jerk reaction to some degree to the volatility in markets, not just the share market, but also commodities markets, and important ones such as oil. So let's keep an eye on that. But certainly the year-on-year data to March is looking positive for a better inflation result, and therefore perhaps the prospect of lower interest rates. But as I said, the April stuff is looking a little stronger. So we need to see how the Trump tariff environment pans out over the next few weeks. But we can bring you these forward signs of the potential for interest rates. So that means that, it helps those planning their property decisions if they can understand more clearly where interest rates may land. But the Reserve Bank is a law to themselves, as we know. So all we can do is provide some guidance based on the evidence is what we do. So house building costs are another important factor in the inflation rate. We can see after a sort of a moderation, we saw an uptick in house building costs over February, a bit of a concern, probably offset by lower electricity costs and lower rents. But nonetheless, this does play its way into the housing costs portion of the inflation rate. So just up a little bit there, and over the year up 5% building costs, which is a bit of an increase. And the ABS hasn't been reporting that. As you can see there, we know that building costs went through the roof as a result of that policy, the home builder policy from the previous government. So again, we've seen some positives there in terms of particularly oil, the impact of oil, but some negatives there from house building costs. And we also have some not so good news, maybe some early. This is the My Housing Market quarterly annual change in home rents of capital cities. And we're just starting to see some early signs there of a breakout, as we discussed in the rent report, of higher rents coming through on an annual basis. So again, this is something not picked up yet by the Reserve Bank. You've got to understand these are asking rents, Chris. So it takes some time for asking rents to work their way into the full rental market, and it is capital cities, so it's not the total rental market, because those that have leases, they're not that concerned in the shorter term about what's happening in the asking rental market. So it takes some time, if you do get rental increases, for that to work its way into the total rental market. But this does give you a forward indication of how the rental market is moving. Not so much a sort of a real-time environment in terms of the CPI, but rents are starting to rise on our annual quarterly index here. And you can see there 4.2%, which is similar to what the Reserve Bank, what the inflation rate was over February. So now this is April to the current week, up by 4.2% over the year, and just starting to rise a little bit. So that's sort of going to work its way over time into the total rental market, which will work its way into the inflation rate. So we've had a big week this week for economic data. So I hope you haven't all fallen asleep. You shouldn't, because it's good news in terms of the prospects for interest rates. But we need another month of data to bring that forward. So maybe the signals are a little bit more positive towards the outlook for an interest rate cut. But of course, we need to look at the latest economic data in terms of the labour market, because it is a little bit, if we're throwing interest rate stimulus into the market with lower rates, we don't want to waste too much of it in case there is a downturn in regard to what's happening in world trade. So auction clearance rates were steady over the week, ending last Saturday, and we had a falling away of actual listings compared to the previous week. Still reasonable listings, but they fell away. But I think that's because everybody's gearing up for this Super Saturday that's coming up this week for the pre-Easter bonanza of auction activity. So that'll be a big test for the market. Let's see how that works. This was the data last week, 991 auctions in Sydney, down from the week before, similar clearance rate and similar to where it was a year ago. Listing numbers higher, but that was the week after the Easter break, which occurred a lot earlier last year than this year. So those numbers were recovering from the Easter break where we look at last year's listing numbers. Well down the Melbourne auction numbers over the week, 1191 compared to 1330. But Melbourne continues to encourage on the upside in terms of clearance rate, 68.7%. We're waiting for a 70% clearance rate in Melbourne. It's got close, but not there yet, but certainly tracking above where it ended last year, and also now tracking above where it was a year ago. Another lowish result from Brisbane. We expect that from Brisbane once that moves into a more normalised market. Still seeing prices growth in Brisbane, but not at the rate we had a year ago, where we did have those relatively high clearance rates for the Brisbane market. 166 auctions in Brisbane, down from 183, higher than a year ago. Again, it was the week after Easter, so we're not really comparing like with like, but the clearance rate well down as we've seen. Adelaide, steady results over the week compared to the previous week, 153 auctions. Clearance rate a little bit higher, but again, Adelaide has been tracking lower than where it was a year ago, although not far away this week. Adelaide market not booming to the same degree it was a year ago. And Canberra, a little bit better from Canberra. Auction numbers a little bit higher. It's a bit of a same old with Canberra, but that's sort of been teasing us in terms of the prospect of a revival. Let's have a look at the monthly clearance rate data In Sydney, certainly been a good start to the year for auction results in Sydney. We know that because we've been reporting on higher prices for both houses and units this year. So that validates us looking at the auction results because it gives us a good forward indicator of the general state of our markets, and higher than a year ago now in Sydney. So let's see how the rest of the month pans out, particularly given it's a holiday month. Same story here in Melbourne. Been a good start to the year in the Melbourne market. We are seeing higher prices marginally in Melbourne and higher than where it was a year ago. Brisbane, conversely, lower, not as strong as a year ago, which was a boom time market. But Brisbane has its own culture in terms of auction activity and auction marketing. So we tend to see lower clearance rates in Brisbane that don't necessarily mean properties aren't selling on the day of the auction or near to it. Adelaide, a little bit lower than a year ago. We discussed that. Not as strong the Adelaide market as where it has been. Still recording prices growth, but certainly more modest than what it was a year ago. And Canberra, will it revive? It's sort of really stuck at around about those mid to late 50 clearance rates, looking similar to a year ago. But we'd want to be seeing plus 60% clearance rates in the Canberra market to be calling a revival there, which has been quite a stagnant market over the past 12 to 18 months. If you're looking for the latest auction clearance rates, you can go to my LinkedIn site, which is at Doc Andrew Wilson at LinkedIn. Every Saturday night at 6 o'clock, you get the capital city snapshots, which you saw today, and you've seen in this report. And if you're looking for the full national report, that's published on Sundays on my LinkedIn site, which includes the regional breakdowns for Sydney and Melbourne and the top 10 properties sold under the hammer over the week in all the capitals. So look out for that one. As we've seen, it's a very good forward indicator, the auction market. You can sort of feel what's happening on a week-by-week market, on a week-by-week basis on our capital city markets. If you missed the latest weekly market report, auction market report, there is a QR code. Take a scan of that, and that will give you a PDF copy to the latest weekly auction market report, which I said is published every Sunday on my LinkedIn site. So just finishing off as usual, this is the great giveaway that we give to all our viewers on the podcast. This is the Infinity My Housing Market Suburb Data app. So this isn't just about aggregated data, capital city data. This is about suburb data. So if you want to know what's happening in suburbs, housing markets, this is the app to get. You can scan that QR code there, which will give you a link to the app, or click on the link there. You need a password to access it. Infinity will tell you how to get that password. It's well worth having. Here's a screenshot of what we offer. So it's every suburb in Australia that has data is listed here. It is the current asking prices and asking rent. So it's telling you what agents and vendors are pitching their properties for at the moment in real time. It gives you not just the state, it gives you the two regions, which is you can filter for, which is the capital city region of each state and the outside capital city region. You can then filter for the suburb. We've got Blacktown here. You can also filter for the type of property, house, unit, or townhouse. And also you can filter for the number of beds. So gee whiz, how specific is that? You can see our result there on the screenshot. It's not just the median asking price we provide. It's also the low and the high, which gives you the range of asking prices in the marketplace currently, and also the number of properties that are for sale. So it's a great guide to what's happening in real time in the housing market. And we do exactly the same thing for rents. So you can see that result there for Blacktown for rent. So get a hold of that. It's a great little part of your toolkit for understanding what's happening in the housing market in real time. Now, also for investors, we have an add-on to our app that we've introduced recently. This gives you the top 10 yields in each of those regions, so capital city region or the outside capital city region. So each suburb is ranked there from highest yield to lowest yield, top 10 there, so that you can understand what the returns are. And these are the returns based on asking prices and asking rent. So these are returns over a year. And these are gross returns, of course. They don't account for your individual costs. So this gives you an indication of the return on investment for the top 10 properties. It also gives us the vacancy rate. So you can see what sort of demand there is for rental properties there based on the comparative vacancy rates. Also, the number of properties for rent and the number of properties for sale there. Now, you can see that there are links highlighted in the suburbs. If you click on that link, it will take you to a map of the actual suburb. So if you don't know where the suburb is, click on the link and it'll tell you where the suburb is. So how great is that, Chris? Fantastic offering there, our Buy Housing Market Infinity Housing Market app, which we offer all our viewers. Next week, we will have, as mentioned, the February home building approvals, retail sales, and our latest weekly auction results. If you missed the report, if you want to get a copy of it, some parts of it for detail, there is a QR code for the full report today. We've gone a little bit over time, but there's been lots to discuss, particularly in relation to inflation and interest rates. It's been a very interesting week, Chris, and I'm sure we're going to get more interesting weeks coming forward. Just remembering that the tariff regime introduced now by the US government is less than a week old. Look at all that's happened in that period. So we will await the outcome going forward. So see you later, everybody. And I look forward to presenting all the fresh data next week.